China readies emergency measures to protect its economy from the trade war. At the same time, Bloomberg learns that Beijing may suspend tariffs on certain imports from the U.S. Now, markets set to end the week on a high, boosted by comments from two Fed officials indicating that U.S. interest rates could be cut. Plus, Alphabet earnings come in better than expected, boosted by Google ad revenue and an investment in SpaceX. Now, first thing is first, we have a lot to get through on the program today, but markets, again, I guess they're on tenterhooks on what happens with trade. And European stocks, but also Wall Street futures, did pair some of the gains. So a lot of them are still up, but a little bit less than they were half an hour ago. And this is because China has been downplaying in the last 20 minutes or so progress in its trade dispute with the U.S. So markets saw a tentative recovery in risk appetite. But again, if you look at European futures, that's being dampened a little bit. And that's also thanks to the White House's conciliatory tone towards China. That put assets up. Let's go to the European markets map. But then a little bit of pressure on the downside. Watch out for gold. We have a wonderful commodities analyst to give you everything you need to know on gold. Dollar also strengthening, yen and Swiss franc retreating again. Investors demanding for non-U.S. haven assets seem to be waning a touch. If you look at the CAC 40, it's gaining some 0.6%, and the FTSE look 0.2% higher. A couple of other things we need to watch out for, mainly because of earnings either today or next week. Alphabet pre-market 5.2% higher, and then Intel will also have our Charlie Wells with a full roundup of some of the main news, including Intel. If we look at pre-market, Intel is down 5%. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Bloomberg understands that China is considering suspending its 125% tariffs on some U.S. imports as the economic costs of the trade war weigh heavily on certain industries. Now, goods being considered for potential exemption include medical equipment and some industrial chemicals. Meanwhile, Beijing is vowing to fully prepare emergency plans to ward against increasing external shocks. Joining us now, Brendan Murray, who coordinates our global trade coverage. So, Brendan, there seems to be a conciliatory tone from the White House, but actually China being much more tentative.
Yeah, exactly. I think this is a small but initial sign that China is feeling some of the economic pain. It's listening to its importers, and it sounds like it's about to offer some sort of conciliatory move to the Trump administration that would ease tensions even just a little bit. We have heard China for several weeks now pretty much ignore the U.S. Until yesterday when they said, we will sit down with you, but you have to remove all these this very high unilateral tariff, something that the Trump administration would be unlikely to do in the short term. So they're still at an impasse apparently, but it seems like the progress is moving in the direction of de-escalation.
Brendan, what's the next step of this? Again, if you look at de-escalation, is there a press conference that we should be watching out for? We also understand that China could do a lot more on the economy.
Yeah, I think it's the ball is in Trump's court now. As he said last week, it's in China's court. China has come back and said, here are the conditions that we will that we have for negotiation. So we'll see if President Trump is willing to put his money where his mouth is when he says he'd like these talks to happen, and that's going to take, as China has demanded, a lowering of these tariffs. The economic shock from those are going to hit both Asia and the U.S. In very short order.
Brendan, what do we know about China exempting some U.S. goods from again, tariffs as costs rise? Do we know exactly what they're planning to do on what sectors or what companies?
Well, there's some key products used in Chinese manufacturing, in the manufacturing of plastics. There are and some other more heavy machinery equipment that China's companies need to maintain their production. So there's a long list of potential exemptions that's circulating, but whether those actually get carried out, we'll have to wait and see. But at the moment, it's just a proposal.
Brendan, there's a lot of talk about the White House, if not, regretting the tariffs, actually having second thoughts on how they went about it. Is this something that you're hearing, or is it something that's pushed by the opposition? Yeah,
it's the White House almost 4 weeks ago sort of came out with this reciprocal tariff plan that surprised the markets and economists for how severe it was. This was going to cause a decoupling of the U.S. and Chinese economies, and it was going to hit allies as well. And I think that there's some recognition that decoupling, and Treasury Secretary Bessent has said so, that decoupling is not the goal, as something less than that is, and that the U.S. will need its allies in this struggle to rebalance the U.S. economy against the Chinese economy. So it sounds like there's some deals being negotiated or talks underway to get deals on the table. That things are moving in a more dovish direction when it comes to tariffs. That the Trump administration has essentially realized that it may do more economic harm to the U.S. economy than good.
Brendan, thank you so much. Brendan Murray there with everything, of course, that we need to know on trade. Now, divisions have emerged between the U.S. and its allies at a flagship international summit on energy security. Speakers, of course, outlined a vision to include renewable fuels in the shift to a sustainable energy future. But Washington's representative repeated the Trump administration's opposition to restricting energy sources in the pursuit of net zero emissions. Well, I'm delighted now to be joined by Leila Benali, Morocco's Minister of Energy Transition and Sustainable Development, who was at the event, who was, of course, co-hosted by the IEA and the UK government that I also helped to chair. So thank you so much, Minister, for joining us. First of all, what's the scale of investment that you see for renewable energy in Morocco going forward?
Well, thanks, Francine, for the invitation. In Morocco, we're still pushing ahead with our energy investments, including the renewable energy. It's a key pillar of our energy strategies, and we are seeing that today you have more than 70% of global trade that's GDP dependent, compared to less than 5% in the 70s. So the whole issue around energy security is being redefined. For us, our energy strategy since 2009 has been stable and the same. Renewable energy, key pillar of our strategy, more than 52% of our target that we will reach in 2026, much earlier than 2030. That's roughly plus 15 gigawatts of renewables that we will add, roughly $12 billion of investment between now and 2030, 80% of it in renewables. Second key pillar is energy efficiency. And third key pillar is regional integration. Whenever stubbornly pushing for energy integration and cooperation when there's someone on the other side.
And Minister, at the same time, does it actually go with plans to phase out coal?
Yes, absolutely. No, absolutely. Because the thing is, Morocco is a net fossil fuel importer. And if it means, if all I would say, the trade tariffs that is happening today it means something. It means that if Morocco has to be the last man standing, investing in renewables, pushing away from fossil fuels, well, then it's music to my ears, because it means that we are showcasing that we are the lowest cost energy supplier, renewable energy, that we are the most connected to the Europe, Africa, and Atlantic basin. We provide the lowest cost delivered energy supply, including to the UK. And also, we are a land of reconciliation where we can have investments in research and development in clean tech.
Minister, can you just update us also on the latest planned LNG import terminal?
All right. I mean, that's also a key part of our strategy, regional integration again. It's roughly $6 billion of capex that we are injecting in gas infrastructure, making it future-proof so that it can actually also make sure that we provide hydrogen and that we can transport hydrogen. Again, Morocco as the lowest cost hydrogen supplier, including to Europe. There's nothing that can beat pipelines when it comes to transporting molecules. And the purpose is to link it to $25 billion of capex to be invested in the what used to be called the Nigeria-Morocco gas pipeline, now the African Atlantic gas pipeline, to get to Africa the molecules it deserves for its development.
So do you already have a specific timeline, actually, on when the terminal will be built, will be starting and finished, but also where the supplies will come from.
Yes, we are pushing ahead for the first entry point for LNG in Morocco in the Nador terminal. So we are really hoping that we will get a first molecule around between 26, 27. The key is already ready and all that. Second key point of entry will be on the Atlantic coast in Morocco, and we are hoping to link all this to Dakhla, which is a major a region for us with the great combination of great solar and wind capacity factors and potential emerging region for heavy, hard-to-abate industries as well.
And Minister, I mean, this is a huge project, something that I know is very close also to what the country wants to do. I mean, the LNG terminal, is it regasification and also a storage, for example, for a floating storage? Is that part of it, or how big will the complex be?
So for now, it's the first entry point will be an FSRU or an FSU, so floating, definitely. A second entry point might be and potentially will be a large regasification on land terminal. But the whole point, what I would want to insist on is this is very much preparing for flexibility in the future. We want to continue to have an agile and flexible strategy. So that's why we are pushing for a first entry point in Nador close to Europe, and making sure that we have access to the international LNG market that provides a lot of optionality. And to answer your second question, where the supplies will come from, well, that's another flexibility that the LNG market has provided compared to pipeline gas. It means you can get access to the international and LNG market.
So are there discussions ongoing now on when the supplies would come from, or is that for a later date? Because again,
we already have contracts already in place, because if you remember, back in October 2021, we were all gathered in Glasgow. This was like 4 months before the Russia-Ukraine war. I was the only one on stage saying, well, if you want us to invest in renewables, we need gas for intermittency. And at the time, we already started discussing, and we made sure that we had at least a 10-year contract, and making sure that we reverse the pipeline with Spain that we already have. We are the only African country interconnected with Europe logistically, culturally, but also gas-wise and electricity-wise and bidirectionally. So we made sure to reverse that gas pipeline to have access to the international LNG market back in 2022. So we already have contracts in place.
Minister, when you look at the energy transition plans for Morocco, are they been upended or moved around because of what we're seeing with tariffs and this new geopolitical order?
No, absolutely not. I mean, for us, this has been the case. We have 30 years of experience in attracting the international private finance. We have 30 years of experience in international energy, environmental and climate negotiations and diplomacy. So for us, it's very important that we stay the course. And if at the end of the day, with all the trade turbulence that is happening today, Morocco emerges as the last man standing, investing in the same energy strategy that it has since 2009 when it was launched by His Majesty, then so be it. It's music to my ears. My job will be done and mission accomplished.
Yes, but you need actually support from the region as well. So it's better if everybody works together, I guess, towards a unified transition.
That's where regional cooperation is a key part of our strategy, and that's why we make sure that with our partners, be it in Africa, Europe, the Atlantic Basin, and Asia, we try as much as possible to have win-win partnerships and a new generation of partnerships. If I take the example of China, that's a best case study where you have more than 70% of clean tech value chains being either localized or having secured equity assets in various parts of the world. So making sure that Morocco, that has more than 60 FTAs with various countries in the world, can concentrate some of that, I think, is key in the international cooperation.
Minister, I know you have to go back to Lancaster House, where there's this Future of Energy Security Summit that's being held by the IEA and the UK. What's your biggest hope in terms of actually achieving something concrete together?
Well, a few things. I mean, I think the first key, Morocco has always been an advocate of multilateralism and an advocate of international cooperation. But when we look at the history of, for example, we have more than 250 multilateral environment agreements and COPs. The key point here is to ensure that those multilateral and bilateral agreements are take into account a lot business opportunities, take into account the fact that we need to build synergies between those environmental agreements and climate agreements, and ensure that our energy strategies go hand in hand. So what I would want to see is a real redefinition of energy security, taking into account not only securing the molecules and electrons, that's a 70s mantra, but now moving to the 21st century and making sure that we secure assets and value chains and productive and consuming assets.
Thank you so much for all of your great insights, Leila. Benali there, Morocco's Minister of Energy Transition and Sustainable Development. Now coming up, global stocks on track for the best winning streak in more than 2 months as trade tensions cool. We'll discuss all of this with Municchi from M&G Investments and Morgan Stanley's Amy Gower. We'll also talk gold. That's next, and this is Bloomberg.
Season is here.
European earnings kick into high gear.
Beginning to gather a little bit of momentum.
Bloomberg is first to break the numbers.
Netflix, Hermes,
SAP as well.
ASML reporting a big miss.
With the smartest insights.
Is it possible for the earnings story to dominate?
Look at the resiliency behind the numbers.
Earnings may even flip into negative territory.
The volatility of earnings really matters now.
It's like a marathon of earnings.
Continuing coverage on Bloomberg. Context changes everything.
Global stocks on track for the best winning streak in more than 2 months. It comes as trade tensions cool and after Fed officials indicated that they'd be open to cutting rates earlier than anticipated.
Wouldn't surprise me that you might start seeing more layoffs, tick up in the unemployment rate going forward if the big tariffs in particular come back on. If I see a significant drop in the labor market, then the employment side of the mandate I think is important and we step in. I would expect more rate cuts and sooner once I start seeing some serious deterioration in the labor market.
Well, joining us now, Municchi, a fund manager at M&G Investments, Amy Gower, metals and mining commodity strategist at Morgan Stanley. So thank you both for joining us. Amy, we're absolutely obsessed with gold. I mean, it's not me, it's like, China, central banks that are purchasing. How do you explain really the rally and what's motivating this pace of gold buying?
Yeah, well, the pace of gold rally has certainly picked up recently. So it took us about 6 months to get from $2,500 to $3,000 an ounce. And then we've done $3,000 to $3,500 in about 5 weeks. And actually, if you look at the volatility, we even did a move that big in about 8 days. So we're moving very, very quickly. I think the key thing that's driving this at the moment has really been that safe haven demand. So yes, the central banks are buying, but they have been buying already for 3 years. That pace hasn't really changed. The new money that's coming in is from the ETFs. And this has been one of the fastest quarters on record in terms of ETF inflows, and that's really that safe haven demand. That's what's kicked it higher recently.
Yeah, and at the same time, Maria, I mean, there's a lot of questions on how treasuries have been behaving, and also how you price in that risk premium for U.S. assets, full stop.
Completely. I think the last 4 weeks have been quite exceptional in terms of the behavior that we've seen in U.S. Treasuries, because the very first week around the 2nd of April announcement, we have seen some diversification properties across Treasuries, but that has quickly reversed the weeks after that, where we see the strong sell-off across all bonds, really. It wasn't just specific to U.S. Treasuries. We've seen gilts as well selling off. We've seen bonds selling off. But after that, bonds, for example, have acted again as a diversifier. They have retraced those losses. They have gone back to lower yields, whilst U.S. Treasuries, especially in the long end of the curve, have kind of remained to higher yields. So they haven't really fully, I guess, responded to that need of diversification for multi-asset portfolios in this phase. But I would also say that what we're observing on risk assets and on equities as well, it's potentially not a full risk off, which will be the situation where you will see potentially developed market bonds act like that safety. In fact, if we look a little bit through a longer time frame, a lot of the sell-offs we've seen in equity markets, and especially after the more recent rebound, we're not really miles away from where we were in the middle of last year. Because at the end of last year, beginning of this year, end of last year in the US and beginning of this year in Europe and China, we had a very strong push up in prices. So it's very difficult to assess how much risk is really present today in markets.
Yeah, I think the markets don't know themselves because they're trying to figure out some of the unpredictability of whether you have tariffs or not. I mean, when you look at Chinese demand for gold, it's still pretty strong. But is there a point where high prices actually start seriously hurting demand?
Yeah, absolutely. I mean, one of the things that's been quite encouraging through this rally is if we do look at that Shanghai gold premium, the premium over the London price, it has kept rising even as gold has risen. So that has suggested that that demand is good. We saw, exchange withdrawals picking up again in March. So all signs so far healthy, but that's really been the investment demand, whereas we are probably seeing a bit of weakness on the jewelry side. And so jewelry is a very, very big category. On a global basis, it's about 40% of gold demand. It's nearly 2 times as big as those central banks. So, and India and China are your key areas. So I think especially the speed of the move is important. That's where, if it's suddenly moved up very quickly, that's where a consumer's going to go, oh, wait a second, do I want to do my purchase now? So I think we are already seeing that, and I think that will continue.
But is it tracking Fed expectations?
The gold price?
Gold price.
I would say not so much at the moment. Gold seems to be disconnecting from macro factors. So for the first until Liberation Day, essentially, gold was moving inversely with real yields. It's now moving in tandem with real yields, which is usually when we see it's either physical demand or safe haven demand. That's when we see the situation. That's what we're seeing at the moment. And I think the dollar is also being quite a tailwind. Normally, gold and the dollar would rally at times of safe havens simultaneously, but maybe gold is even getting some of those safe haven flows that might have historically gone to the dollar.
And Maria, again, everything seems to be moving on expectations of the Fed, and that's moving quite quickly on growth expectations, right? And it feels like these tariffs, we don't know what happens, but at the moment that would hit GDP more abruptly than inflation.
Yeah, this is certainly what we can read both from market reaction as well as some of the latest forecasts that have come out. For example, from IMF, we have seen a reduction on expectation for US growth quite significantly for 2025. And yes, I think the market has reacted with a worry around growth more than around inflation. And that is probably correct because these type of tariffs are more likely to act as a sort of tax. But it's important to highlight that there are a lot of direct consequences to the tax, but there are also a lot of indirect consequences. And what happened in the 2nd of April was a little bit like playing pool and having a break move where, you hit the balls and then kind of see where they land. But it's a long-term game. We know that historically to negotiate a trade deal, even just between 2 countries, have taken years. And now we're talking about multiple countries and we're expecting 90 days. I think, we should be ready for more volatility in the market and for this trend to continue for a longer period of time until we get to a resolution. But obviously, markets will try and find, the answer today or tomorrow, and they will move with that. So I think that would also potentially offer opportunities for investors from a tactical standpoint.
I mean, it's interesting. Market psychology and actually what investors are thinking right now is extremely interesting when you look at certain points. So the way they behave, for example, in gold. I mean, are they willing to give up yield in gold just to have that haven?
I think at the moment, yes. But I have to say, it doesn't feel like this is a big sort of investor inflow, particularly into sort of gold futures. So if we look at the COMEX positioning, it's actually been coming off. And we're back where we were about May last year. So it's really been those ETF flows, which is a mixture of investors and then also perhaps that retail side as well. So I think eventually that yield question will start to come into play again. And that's, I think, the key thing we need to watch. We've seen 3 days now of ETF outflows. I am tracking that very closely because that's really what's got us here. And that's what we need to continue for us to see gold keep rising.
Do you see a change in behavior, actually, of how much is demanded to take certain, for example, when you look at treasuries or just actually the bond move in general? We have a great piece on bond vigilantes. But does investor behavior on some of this, fixed income change for the longer term?
I think we have seen investors being more reluctant to engage with developed market bonds, in particular treasuries, because volatility has been ongoing for a long period of time. I mean, we've navigated all the way through higher interest rates, and the higher for longer phase was also disappointing for some investors. So I think some investors are losing faith on these assets in order to be able to diversify. But we know that when that happens, it might be actually the right time to actually be engaged, because that's when they start working, and they do work when risk off is at its highest, peak uncertainty, and we potentially are not yet at that peak uncertainty level. I think also the other thing that's been very interesting to note is that that increase in yields in the middle of April has been across the board. So yes, there was an element of U.S. Treasuries, but it's brought other assets with it, so gilts and bonds. So that has been a good opportunity, I think, for investors to add to, for example, bonds exposure, which could be a good diversification for portfolios.
Thank you both for joining us, Maria Municchi and Amy Gower. Coming up, we talk a lot more actually about banks, but also we focus on tech and Alphabet. This is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. China readies emergency measures to protect its economy from the trade war. At the same time, Bloomberg has learned that Beijing may suspend tariffs on certain imports from U.S. Markets set to end the week on a high, lifted by comments from two Fed officials indicating that U.S. interest rates could be cut. Plus, Alphabet earnings come in better than expected, boosted by Google ad revenue and an investment in SpaceX. Now, in the last couple of minutes, we had some breaking news out of the U.S. Well, actually, it's a Bloomberg scoop saying that a U.S.-India trade agreement is under discussion. And we understand that the U.S. is seeking an India trade deal on 19 categories. That would include greater market access from farm goods, e-commerce, data storage, and critical mineral. Again, it would be a first step towards a deal that may then help India evade higher tariffs on its goods. Now, if there is something concrete or if there is some kind of agreement, this, I'm sure, would be welcome relief, not only from both countries, but from a lot of negotiators around the world that also have to deal with the U.S. and the Trump administration in trying to figure out what the next phase for their tariffs is. Now, in terms of reference for a bilateral deal, again, this is a Bloomberg scoop, which was finalized by both sides this week. It could also include trade in goods as services. Again, these people that we've been speaking to have asked for the moment not to be identified, as the discussions are private and ongoing. Now let's move on to tech and Alphabet earnings and the rest of today's tech news. Now Bloomberg's Charlie Wells joins us. Charlie, first of all, let's start with Alphabet. Pre-market, it's gaining 5%. I mean, they didn't have bad results, but they have a little bit of investment coming their way.
That's exactly right, Francine. So these are results that were better than expected, and they came on the back of strong search advertising revenue. Now, this is important momentum that Google needs as it seeks to justify its investment in artificial intelligence, which it has certainly been doing quite significantly. We also, on that AI front, saw strong consumer demand in Google Cloud, which is also a step in the right direction as they try to justify why they are making these big investments, which have come under question recently. So this was a strong report, and we're seeing a strong response in the market.
Charlie, how much detail did we get on Intel's strategy in the earnings call as well?
Francine, it was almost a story of a very different tech company facing very different challenges. Now, they posted a forecast for the current quarter that was worse than expected. Analysts also had been hoping for more of a specific strategy from Lip Bhutan, the new CEO of Intel who took over just last month. He talked about the need to slash jobs, to cut through management, and to bring employees back to the office. But he didn't give the sort of details that analysts had really been expecting and hoping for regarding competition, regarding external threats, and AI, in which Intel has ceded ground to the likes of NVIDIA.
Charlie, Bloomberg has also learned that Apple aims to import most of the iPhones it sells in the U.S. from India. What do we know?
So what we know is that if Apple were to do this, this would be a strategic pivot out of China and towards India, of course, on the back of these trade tensions, but also geopolitical risk. But this would be a very difficult goal to meet. Apple would need to roughly double the amount of iPhones that it produces in India in order to make this happen. So a strategic pivot, but something that seems increasingly important for this company as those trade tensions ratchet up.
Charlie, thank you so much. Charlie Wells there with the very latest on some of the tech earnings. Now turning to banking, which will be under the spotlight next week as the bulk of the big European banks report. First quarter earnings could meet or exceed expectations. Analysts warn of looming downward revisions for many lenders. Now joining us now, Anke Reingen, co-head of global financial research at RBC Capital Markets, and Paul Davies from Bloomberg Opinion, who covers banking and finance. Thank you both for joining us. Paul, I mean, earnings are important because they give some indication of of how much pain they're feeling from tariffs, how much pain they're feeling from, possible loans going sour or just investors not doing M&A and capex. What's the level of stress amongst financial institutions and banks because of the tariffs in the last 60 days?
Well, I mean, what we're going to get when banks report next week is a lot of is commentary on the first quarter, which is before most of the madness really happened, right? So the numbers are still going to be quite good, especially on the trading side. In terms of the impact on actual credit demand or cost of credit or credit risk and that sort of thing, it will be much more important to hear what the outlook is from these executives about how conditions have developed since the 2nd of April and how they see things developing really over the second quarter and into the rest of the year.
Yeah, and Anke, I mean, this kind of goes to the point that, BNP Paribas joined, Wall Street banks in frankly doing really well on equities, but investors are disappointed because they worry about, trade war worries and some unpredictability from the U.S. Is there any European bank that will be a blowout?
Well, I guess as Paul said, as Q1 is a bit of a history now, and we were looking for the outlook statements. And frankly, I'm quite relieved finally we get some tangible. In the past it's always following headlines, and now we get some tangible commentary from banks about their outlook. And to the point, I think it will be very different by bank, the outlook statement. It depends on your interest income gearing. It depends on investment banking. There'll be lots of questions about loan losses. I think it's more like a check-in point in what the banks are currently seeing rather than an adjustment in numbers. And I think the banks that are more geared like a steeper curve have the investment banking. They're probably somewhat better positioned, but clearly it's an area of uncertainty and we're looking for data points.
Which lenders, Anke, have the worst business mix for the current situation?
Well, I suppose if you don't have diversification with investment banking, you wouldn't get the trading part. You'll probably be looking for a geographic mix as obviously a function of as well if you think tariffs in Asia, US slowdown, so geographic mix plays a role. But clearly, I think in the rate gearing, we're looking for banks that have a gearing to steeper curve rather than short rates. In terms of asset quality, I think it's too early days. Q1 will not show any signs, and it's more about forward expectations. And I think it might be a small uptick, but not meaningful. And a lot of banks still have buffers. So it will be very much dependent by bank and how the outlook develops, quite frankly.
But if you're a big investment bank, you're probably wishing you had more of an equities exposure or trading exposure at the moment.
Yeah, absolutely. And, Deutsche Bank obviously got rid of their equities trading division a few years ago. Everybody else is showing fantastic numbers on equities. I think the US were up, on average kind of nearly 30% or something. BNP yesterday, huge growth in equities trading, and they've been making great strides there in recent years. So that's going to be great for UBS, it's going to be great for Barclays, it's going to be great for SocGen. The FIC side, the fixed income and currency side has been just kind of generally quieter or not showing so much growth compared to last year. So, for Deutsche Bank will be the one whose trading business might not be quite so glowing as the rest.
But are you worse off if you're a U.S. bank, Paul, than you're, let's say, an Italian bank, because there was much more premium attached to the good that a Trump administration could do to them in terms of deregulation and things like that?
Yeah, absolutely. I think, the US stocks have fallen a lot on the realization that life is going to be much rockier there. European banks have been outperforming spectacularly or doing very well for a couple of years already. I think some of the really interesting things will be what banks see in terms of reinvestment in Europe and kind of gearing to doing more lending within Europe. BNP was very positive about this yesterday. And the other thing I've been asking people about is trade finance, which is obviously the thing you expect to come most under pressure in a trade war, obviously. But in fact, it's been really quite healthy. And again, BNP yesterday when they reported were talking about how trade financing has been higher volumes than they would have expected, and it's not because trade isn't getting hit, it's because people are diversifying, the sources of where they're getting supplies from and where they're trying to sell to.
Anke, are you expecting provisioning from European banks, or is it a little bit too early? Do we need to just wait and see?
I mean, so far we have seen some banks, or a few number of banks, booking some procyclical provisions, but I think it's going to be very much bank dependent on how conservative they want to be. I mean, a number of banks also still have some remaining buffers, so they might decide not to do so. I think it's probably more maybe Q2 once there's more visibility, but for now, I mean, we have seen larger cases on the corporate side already last year, so that might remain a theme, but very little in terms of procyclical provisions.
So some say, probably the most optimists of this world, say that a trade war is good for Europe on two fronts, that it forces a capital markets union or Europe to get its act together, but you could also see pension funds and others shying away from big U.S. institutions to move into actually investing with European institutions. I mean, could that happen?
Yeah, I mean, that's following up from a point Paul made as well on BNP yesterday. I mean, clearly there is the investment part that's been coming into Europe where you could see some GDP upgrades. You see the capital markets union, more securitization, SRTs, investments, pension reform. I think the key is it's a big concept at the moment. Right. So, and the implementation is key, and it probably won't be coming in very quickly, but there seems to be a pulling together, which in the long term could be positive, and that against the backdrop of a steep curve, which we really haven't had in Europe for a long time, could be supportive once that fog has lifted on where we are going.
Do you think, Paul, that U.S. big banks and Wall Street will lose business because of the trade war?
It's a really interesting question. I mean, I've been asking lots of European bankers this, and they've been optimistic about the idea that they might win more, and I think, perhaps almost on a sort of a patriotic basis from European CEOs looking to do business with local partners rather than American partners. I mean, I guess the longer the trade war goes on, the more there is a threat that Europe might start thinking about, services tariffs against US businesses. I mean, it seems to be, distant for now, but that's where the US has a trade surplus. So, if the US is really going to come after Europe, why shouldn't Europe go after the US in that way?
I mean, I know there's something, Anke, that Paul is working on almost on a daily basis, which is what will happen to UBS and how will they regulate it and what kind of capital demands will Switzerland put on it. Where do you see that landing? Because UBS also came back fighting.
Yeah, I mean, it's a bit like they're doing really well on the things they can control. So it's a bit, it's really quite sad that there's this large overhang about the too big to fail rule, the quality of capital debate. I think where it's landed, it's very difficult to say, but clearly there are a lot of stakeholders involved. So I hope a balance between all involved parties will be found, and there's a solution of a phase-in. I think at this stage we're in a position, it's most important to know actually what will come in, and then reset and move forward rather than having this uncertainty that's already a year above the UBS stock. Where it lands, it's unclear, but clarity is really important for the company to move on.
And Paul, let's finish off with Italy, which is like a test case for a lot of reasons. So, I mean, you have Generali. You wrote a great opinion piece on Generali Unicredit and the fact that whatever the government decides for these two big companies will be a test for also its future. But it's complicated because you have shareholders, you have shareholder agreements on both sides. Actually, it feels messy.
Yeah, and, we were just talking about the optimism of banking, capital markets union and so on in Europe to kind of draw together and make Europe stronger. This is what's going on in Italy is dragging all of these financial firms back into, being bogged down in a much kind of like more old-fashioned, very nationally focused, very nationalistically interested, power struggle within finance. And, after yesterday where Unicredit, they had this intervention from the government on their BPM deal. Then they've decided to vote kind of in line with the government's allies over the Generali board. And now the discounts for both, Unicredit's bid for BPM and Montepaschi's bid for Mediobanca have widened since then. It's people just don't see this as a good set of outcomes, I don't think. Yeah,
so we'll be following it very closely. Thank you both for joining us. Anke Reingen there, the co-head of Global Financials Research at RBC Capital Markets, and our very own Paul Davies from Bloomberg Opinion. Now, Canadians vote in an early general election on Monday. It was called by Mark Carney after he was elected leader of the Liberal Party last month. Here's what to expect.
Prime Minister Mark Carney, former governor of the Bank of Canada and the Bank of England, leads the Liberal Party into the election after taking office last month.
My government will put into action our plan to build a stronger economy, to create new trading relationships with reliable trading partners.
Carney's rival is Pierre Poilievre, the leader of the Conservative Party. A few months ago, Poilievre was riding high. Polls showed him heading for a landslide victory, potentially securing a two-thirds majority in the House of Commons. But things have changed. Since Carney entered the race, the political landscape in Canada has shifted. Poilievre's lead has evaporated, and both the New Democratic Party and Bloc Québécois have lost ground. If the Liberals don't win a majority, however, they'd need support from the NDP or Bloc Québécois. Complicating matters, U.S. President Donald Trump's aggressive trade policies, particularly new tariffs on Canada, are dominating discourse about the election. On top of that, Trump's suggestions Canada could become the 51st state in the U.S. have drawn more attention than domestic issues, and those comments have changed the political climate. Both Carney and Poilievre have taken a strong stance against Trump's provocative rhetoric and policies.
The president is betraying America's closest friend and attacking our economy, proving once again that Canada must end its era of overdependence and weakness.
For Canadians, this election is a referendum on their economic future. The outcome could determine how the country addresses these challenges and how it positions itself on the world stage.
And of course, we'll have full coverage of the Canadian election next week. Coming up, the Trump administration pushes for a peace deal in Ukraine. We'll have the details of the latest U.S. proposal to end the war. Tomorrow, also, world leaders will gather at the Vatican for Pope Francis's funeral. Tens of thousands of people continue to pay their last respects to the Pope at St. Peter's Basilica. These are live pictures. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, we'll talk more about markets shortly with Simon Kennedy, our senior executive editor for macro markets. But first to geopolitics. And Bloomberg understands that the U.S. is set to demand that Russia accept Ukraine's right to develop its own army and defense industry as part of any peace agreement. Now, the move would push back on Moscow's insistence that Ukraine largely demilitarize as a condition to end the war. President Trump is optimistic a ceasefire can be achieved, despite Russia's continued strikes on Kyiv. Now, he said yesterday that he's using, quote, a lot of pressure on both sides.
Putting a lot of pressure. You don't know what pressure I'm putting on Russia. They're dealing. You have no idea what pressure I'm putting on Russia. We're putting a lot of pressure.
Can you maybe tell us that?
We're putting a lot of pressure on Russia, and Russia knows that, and some people that are close to it know, or he wouldn't be talking.
Now, for more, let's bring in Rosalind Matheson, Bloomberg's EMEA news director. It's confusing to me how close actually Donald Trump and Vladimir Putin are, and whether he is putting pressure or he's not putting pressure. Ross, how do you see the situation?
Well, he's clearly a bit frustrated. And again, he was quite critical of Russia for the latest airstrikes that were done yesterday across quite a large amount of territory in Ukraine. He's frustrated because there's not been a ton of progress towards a deal, and he very clearly wants to get one. So he is not just leaning on Ukraine, he's also leaning on Russia here. And we know from our reporting he's also got some lines there as well with Russia. It's not just Ukraine. He's saying, well, Ukraine should have the right to have its own military in all of this. But it's interesting to see him talking about, again, defense industry and the Zaporizhzhia power plant. And those are also important for the US because it's quite clear that Donald Trump wants to have access to Ukraine in the aftermath of this conflict. And he particularly wants to have access to Ukraine's economy in the aftermath of this conflict. And so you can see there is some self-serving parts of that also for the US, but there is that sense of frustration creeping in. We know that the special US envoy, Steve Witkoff, has apparently just landed in Moscow, and he'll probably meet with Vladimir Putin. He tends to meet with Vladimir Putin when he's there. Maybe we'll get something out of that. But you can see we're getting towards May, and at this point, there's no formal deal.
Ross, I mean, tomorrow, and we've been looking at live pictures from St. Peter's Basilica for the funeral of Pope Francis, which will happen tomorrow. I mean, this is is also a world event because you have many world leaders showing up, including President Zelensky and President Trump. Do we know if they will meet?
Well, we don't know. And we do know that Donald Trump, is only there for a very brief amount of time. I mean, he's going to fly in probably and fly out again shortly afterward. You can expect he's not going to spend a lot of time on the ground. So does he even have a window to meet the Ukrainian President Zelensky? We know that Zelensky would like to meet with him, but so would a lot of other leaders who'll probably be there, obviously for the Pope's funeral, but also with the opportunity to spend a little bit of time with Donald Trump on a bunch of issues, including trade as well. So is there a window for an early morning meeting with Zelensky? Possibly, but we don't know that for sure. We do know it's one thing the Ukrainian president would no doubt like to happen.
Okay, let's also shift the focus to the IMF spring meetings in Washington. Banking leaders and policymakers downplaying the prospect of a looming financial crisis, despite warnings that the U.S.-led trade war threatens global stability. So let's also bring in Simon Kennedy, our senior executive editor for macro markets. I mean, Simon, no one's, again, slept in 3 weeks because of all the market volatility. Like, where are we on first of all, the bond vigilantes, on, how the Treasury move maybe focused the minds of the White House?
Yeah, so I think we've seen a little bit of stability in the last few days, certainly since that reversal from the president, the introducing of the 90 days. But there's still some great scepticism within the bond market about whether, how honest a broker the president is on a whole range of issues. Just in the last few days, we had a flare up about Jay Powell and his future, and then that was somewhat clarified. But you've got a combination of a trade war, you've probably got tax cuts coming, you're not sure what shape they will take, you don't know what the trade war plus the tax cuts mean for inflation, mean for the economy. Throw in some lingering doubt about the independence of the central bank, and if you're a bond market trader, you're probably asking for a little bit more on the yield to invest, and that's what we're seeing, this kind of lingering, lasting perhaps lift to bond yields.
Yeah, I mean, does the president reverse course? His popularity, I think I saw some recent polls, was also going down. Do we know that the president cares about that and therefore changes also prospects for the economy, or is that, wishful thinking?
Well, he says he doesn't care, and he says he doesn't really care about where the market is either, although it's quite clear he's been watching at least the bond market of late and paying attention to that. And it seems that he does care what companies say, because big US automakers are going into the White House one by one to say to him, what you're doing is going to damage our companies and damage our ability to hire people, and that will affect the US economy. So it's clear he is listening to some of that. But equally, you can see, as Simon was saying, the volatility in his decision making, and it's very difficult as a result to know what's going to stick from day to day, or even, frankly, hour to hour. And so making investment decisions, working out how to interact with the US if you're another country, the leader of the country, becomes very, very difficult. But you do know, at least in all of this, the one thing that is clear is if you can get in Donald Trump's ear in the right way, in the right minute, you do have a chance of getting him to change his mind.
Yeah, I mean, there's been huge moves actually on the back of all this uncertainty in gold, as you say, treasuries. I mean, some of the other havens like yen and even Swiss franc. I mean, we've seen, I don't know how you describe, the shift. Is it a dramatic shift out of U.S. assets and then it's kind of like coming back, tentatively, or are we going to keep on seeing these big shifts?
Well, yeah, the question is this lasting? Does everyone get through this? Traders at Goldman Sachs call it headline roulette, But if you look at how the stocks have performed, if you look at how the dollar performed, if you look at how treasuries have performed this 100 days just next week, there's definitely a question about both US exceptionalism and some skepticism towards the administration's kind of grip on markets. And yeah, so once the money leaves, it's harder to come back in. There is an absence, though, of other safe havens. Debt markets aren't as liquid as they are elsewhere, as they are in the US. Currencies aren't as powerful. You look at China, that's a currency managed by the authorities. The euro still doesn't have that depth of debt market beneath it. So the safe haven status is definitely in question. Whether it's truly over is perhaps disputable.
Even for treasuries?
Even for treasuries. They traded recently like a risky asset. And lots of people, Larry Summers pointing out that they're trading like emerging markets. Usually treasuries, whatever the issue, if you look at after 9/11, if you look at the financial crisis, treasuries went up at times of risk, even if that risk was based in the US. In this occasion, you have risk coming from the US and Treasury selling off.
I mean, is there any, and I've heard this, from some, I guess, insiders also, that the tone at the IMF was a bit more subdued because they don't want to antagonize the president. So actually, they're a lot more worried about growth prospects for their economies, but the ministers don't want to blame it on Donald Trump for fear of retaliation.
Well, it was a pretty subdued tone, but also you did see comments still endorsing the US. You saw quite a few officials saying, to Simon's point, the dollar will remain the reserve currency no matter what. And we do see the need to have exposure to the US. So trying to, in a way, talk up the US economy, at the same time, but expressing concern about the longer-term outlook. It's very difficult to forecast. You can see it in the earnings reports that are now coming out from companies. There's no visibility about what might be the impact on their earnings and therefore also on economies and growth and inflation, not just in the US, but in Europe and elsewhere, not just the rest of this year, but into next year.
Thank you both for joining us, Rosalind Matheson and Simon Kennedy. Now, we'll also leave you with some live pictures from the Vatican. World leaders flying in Rome tomorrow ahead of Pope Francis's funeral.